the markets at this point in time distinctly subdued. 0.5% shaved off Sensex and Nifty, and on the mid caps it's a 0.3% cut. The advanced declines are almost two declining for one advancing. I mean, at 700 to 400, okay, maybe not as drastic as I put it, but nevertheless, about 66% of the market is lower than where it was yesterday when we ended trading. Is that an opportunity to buy? Is the best of the pre-market, pre-budget rally over? And what is in this market for the long haul? For all those questions, the market master of the day, Mr. Manish Gunwani, Senior Fund Manager at ICICI Prudential AMC, joins in. Morning, Manish. Thank you very much for dropping by. Well, what is the sense you're getting? We already had 8% of the rally for the year. How much is left this year?
Well, obviously it's been surprising the way the market has moved up, and I guess it is natural that if you see a very sharp up move, the prospects for near-term returns go down. So it's quite likely that we might see a consolidation or a minor correction going forward. Also, the supply of paper seems quite large. What's there in the pipeline?
Yes.
You're looking at the divestment, you're looking at some big banks raising money. So given all this, probably a reasonable chance of a correction or consolidation move. But yeah, again, from 2-3 year perspective, things look okay because the macro data points seem to be getting better and better, which should kind of lead to earnings growth. So from a 2-3 year perspective, things are pretty okay.
Okay. Well, that earnings perspective was what I was next coming to. The numbers that we are getting so far have not been gung-ho third quarter numbers. Several of them have disappointed. I'm also a little worried about the rupee appreciation. You know, in the 2 quarters ago, we were actually moving well on export earnings. I mean, Bajaj Auto would be a case in point. And there were several companies where actually the export sector bailed out the domestic sector. That advantage may run out, do you think? And therefore, is the earnings growth, inflection point getting postponed?
Well, let's start with earnings. I think next 2-3 quarters are not going to be great on earnings because it will take time for the investment cycle to revive. And that is a part of the market that's been holding back earnings, the cyclicals, right? I mean, the staples and the IT pharma have been doing pretty well last 3-4 years. Given the state of balance sheets in the private sector in capex heavy industries like infrastructure, metals, I think it would be unfair to expect that the capex cycle would turn on like a switch, right? It'll take time to come back. So to that extent, yeah, you could see some minor downgrades in earnings even for next 2-3 quarters.
Oh.
But I think the market can look beyond that because, as I said, the macro in terms of lower inflation leading to lower interest rates, very healthy CAD numbers you're likely to see for next few quarters, which brings me to your second point about currency. Now, that's a very tricky debate because at one level, obviously, if your current account deficit is going to be 0 or even positive, probably happening after 10-11 years, there is no fundamental reason for the currency to depreciate. But if I were in the policymaker's seat, I would definitely consider the fact that a lot of industries are facing import competition because on a real effective exchange rate basis, we're pretty high at this point of time.
Overvalued 10%, I checked the last number.
So you will see imports facing very stiff competition to domestic industries. And given that employment is one of the key objectives of any policymaker, it is a very tricky debate what to do with the currency. I guess the policymakers will not want very steep appreciation. That's very clear. The question is how much can RBI buy dollars to keep rupee soft, and whether that is the core objective. I think it's a big debate.
Sonia.
Okay. Manish, hi, good morning. This is Sonia here from the Delhi studio. Just coming back to that point you made earlier about supply hitting the market, in your assessment, what happens, when there's a lot of paper hitting the market? Is it a reversal of the positive trend, at least for the near term, or is it used as a buying opportunity by investors?
Well, difficult to see what the end effect can be, but at the margin, it's obviously a headwind for the market because end of the day, any market is the balance between demand and supply. And we're seeing some pretty big numbers out there. If you look at in the next 3 to 5 months, let's say, you're looking at some very big divestment issues, you're looking at some very big bank issues. So obviously at the margin it's going to be one headwind. Now the overall effect obviously depends on a lot of things, how global risk on, risk off, FI flows, domestic flows, etc. But at the margin there's definitely going to be a challenge, especially because you've seen such a sharp run over the last few weeks. And to that extent the valuation obviously today versus 2-3 months back are looking much more stiffer.
Okay, fair enough. I just was going through some of your key portfolio changes in your blue chip fund, and you have added exposure to the oil and gas, the cement space and the banking sector during December of last year. I wanted to talk specifically about oil and gas. What pockets have you added exposure to, and what could be the key positive triggers from here on?
Look, from a top-down perspective, the way we are looking at the market is obviously from a macro viewpoint, the domestic cyclical sectors is where you're going to see a lot of earnings come through over 2 to 3 years. But again, the valuations on a historic basis are now touching, the highs. So to that extent, obviously you have to bet on the length of the cycle rather than the cycle today. Now, against that, you have a set of sectors which have underperformed, which are primarily energy, commodities, telecom. So I think we are kind of balancing both these pockets of the market. We still think domestic cyclicals from a 2-3 year perspective look interesting. But again, as I said, because they've seen such a steep run, you have to be very selective about where you want to be right now. On the other hand, given the steep fall in crude, a lot of oil and gas stocks have got hammered, and some of them have downstream exposures which actually benefit from falling energy prices, because India is an energy deficient country, and downstream companies, it's great for them that the energy prices are down, because what it means is when the growth in the economy comes back, you're going to see a lot of volume growth in those downstream companies. So generally we're preferring downstream energy companies over upstream at this point of time. But at the same time, even upstream companies, some of them, the valuations are building in crude staying here for a lot of time, and that may not be true, because globally you're already seeing capex in oil and gas being cut, which is a sign that at these prices a lot of producers are not finding it remunerative to produce, which typically is a sign of commodity bottoming out. So it's all a kind of mix and match between all these different sectors.
Okay. What do you think will be the leaders of the rally for the next, say, 12 months?
Again, very difficult to say, but maybe it still be domestic cyclicals.
Okay. What about mid caps? Will they outperform, you think? You think big caps are now getting valued to perfection?
Even last time I said looking like very balanced between large caps and mid caps. Today we don't have any top-down call saying this versus that, because mid caps have obviously done very well last 4-5 quarters, and therefore we think today that we need to be kind of neutral between large caps and mid caps. We're not seeing any great arbitrage just by being in mid caps.
Will you be neutral between fixed income and equity?
Fixed income call, part of it has played out. So, but again, equity has done well as well. So I still think fixed income for next 6 months might marginally outperform equities.
Oh, marginally outperform.
Maybe.
Okay. I believe there is a question on our Money Control message board for you. Well, Money Control message board writers are pretty direct in their questions. I wonder how much you can answer. Rahul has written to us from Mumbai. He wants to know the outlook for Ashok Leyland.
Yeah, so we don't comment on stocks. Obviously, the CV cycle seems to be reviving, but a lot of it seems to be priced in as well in a lot of the companies which are exposed to the CV cycle. But yeah, we can't really comment on stocks per se.
Okay, but you're positive on the CV cycle itself?
It looks like that, yeah.
Okay. Well, very quickly, which will you prefer? Private banks, PSU banks, NBFCs?
Again, Lata, I can't make a top-down call because, okay, let me just kind of nuance this a bit. PSU banks, we're typically preferring to be only in the top 2 or 3 because we think the mid-cap PSU banks may have certain challenges in raising capital. There is very limited appetite at this point of time. The tier 1 ratios are pretty low. So the mid-tier is generally something we're not very positive on at this point of time. Private banks, frankly, again, the valuation now look very stiff. So if we are holding it, it's from a 2-3 year perspective. We're not expecting that the next 6 months or 12 months we're going to get spectacular returns in that.
All right, we'll let you go because our sister channel CNBC Awaaz is screaming at us. You are their guest. Thank you very much, Manish, for joining us.